So good morning, everyone, and thank you for joining us for this ceremony webinar in the honor of the 2024 Brattle Group Prize. This is the 26th year of the prize. For the 25th anniversary last year, the JF and Brattle had the idea of hosting a webinar to celebrate the 25th anniversary. And it turned out to be a great idea. So we decided to continue the tradition and hosting a webinar. So good morning, everyone. My name is Thomas Philippon. I'm a co-editor of the Journal of Finance. And today I am joined by Shastri Sandy from the Brattle Group and from the three winners of the 2024 prize, Nadya Malenko, Doron Levit, and Ernst Maug. So a few words about the webinar, and then a few words about Brattle, and then we'll get started. So the prize is awarded annually for outstanding papers in corporate finance. And in the webinar, we're going to hear about this year's paper on voting and trading by shareholders. We are going to go until noon, and we will have time at the end for Q&A. So the prize is sponsored by the Brattle Group. The Brattle Group is a global consulting firm with many people, like 500, spread across North America, Europe, and Asia Pacific. The most important thing for us economists is that Stu Myers, one of the founding fathers of corporate finance, and I had the chance to take his classes at MIT when I was a student, was one of the founders of the Brattle Group. So the DNA of Brattle is squarely in the research domain. To say a few words about Brattle, I will hand on the floor to Shastri Sandy, who is a principal at Brattle Group based in Chicago. So Shastri.
Yeah, thanks, Thomas. Good day, everyone. I'm pleased to be here on behalf of the Brattle Group. As mentioned, I'm Shastri Sandy, a principal in our Chicago office. At Brattle, we work on complex issues in finance, and we deeply value academic research for the insights and rigor that they bring to the type of questions we at Brattle face every day. We're proud to support the Brattle Prize, recognizing outstanding research in corporate finance, something we've been honored to be part of for more than 25 years. As Thomas mentioned, today's webinar is an excellent opportunity to learn more about the 2024 winning paper, Trading and Shareholder Democracy. On behalf of Brattle, I'd like to offer congratulations to the authors, and we're looking forward to a great conversation with them, as well as questions from the audience.
Thank you, Shastri, and congratulations to Doron, Nadya, and Ernst for a well-deserved prize. So we're going to hear the presentation. After the presentation, in fact, during the presentation, there is a Q&A chat, which is open in your Zoom window, and you can type in questions, clarifying questions or big picture questions about the paper at any time. And then when you type a question in the chat box, your question will appear in our screen for us, the panelists, but they will not be publicly visible until we actually answer the questions. Okay, so don't be worried. Just type any questions you might have during the talk, and either we'll answer the question during the talk or afterwards during the Q&A. The Q&A will start at the end of the presentation, and we should have about 20 minutes of Q&A, and then we'll finish at 12 sharp. So now I'm gonna hand over the mic to Ernst Maug, who's gonna present this year's winning paper. The title is Trading and Shareholder Democracy.
Yes, thank you, Thomas, and we are grateful for this opportunity to present our work, and I will be the presenter today, and Doron and Nadya will be monitoring the chat and address all your difficult questions. In this paper, we address corporate governance and shareholder voting from basically two new angles. So the first one is that we assume that investors are heterogeneous and have heterogeneous preferences and beliefs. So they have different values about what they're voting on, and they may have also different views about how the world works. Second, at the voting stage in our paper is actually preceded by a trading stage. So before any decision is taken, investors can actually choose their ownership through buying and selling shares in the stock market. And that renders the shareholder base endogenous. So it's endogenous to the process because it results from trading. And from this framework, we pull out important implications for corporate governance. Let me contrast two paradigms. The first is the conventional paradigm of homogeneous shareholders, and the second is the heterogeneous shareholder paradigm we are going to work with. If we assume that shareholders are homogeneous, then there is effectively one dimension of conflict, which is the one between managers and shareholders. That's kind of enshrined in agency theory. That's a traditional view that is expressed in most finance textbooks we have all been raised on, goes back to Jensen and Meckling in the early days of our research paradigm. So with heterogeneous shareholders, there is a second dimension to the conflict, and that is between shareholders and other shareholders. And that is basically what we want to emphasize here, that shareholders among themselves have different interests. With homogeneous shareholders, there's one clear objective. It's typically referred to as shareholder value, and that is what constitutes the objective of the firm. With heterogeneous shareholders, there actually is no unique common objective because in some sense, each shareholder is going to have its own value. So each shareholder has a different view about what the firm should be doing. Now, with homogeneous shareholders, the main objective of a shareholder meeting and of shareholder voting is to prevent capture of the board. That's the shareholder democracy paradigm we are going to talk about. And trading is then about what we have all kind of taught our students in Finance 101. It's about risk return and potentially also about asymmetric information. With heterogeneous shareholders, now the voting process has a completely new separate objective, and that is to resolve this disagreement among the shareholders with their different views and opinions. And the trading process also has an additional task, namely of matching investors to the firm and thereby homogenizing the shareholder base that is going to be important at the voting stage. So homogeneous shareholder paradigm is familiar. It provides the theoretical underpinnings for most regulation, and it's also the theoretical framework for the interpretation of empirical studies. And this is what leads the drive to shareholder democracy. The principle is pretty simple. If our shareholders are all the same, they need to protect their interest. And the best way of doing that is to vest decision-making in those who are actually most affected by the decisions, namely the shareholders themselves. That's also the familiar principle of power to the people that underpins political democracies. Those who bear the consequences should also be in charge. Unfortunately, the heterogeneous shareholder paradigm has one thing in its favor. It's supported much better by the empirical evidence. And if we then add financial markets, then shareholders trade in these markets and realize gains from trade. And that sets in motion a number of steps and implications, which in the final conclusion lets us strike a more cautious note on the whole concept of shareholder democracy. Let me say something about the empirical evidence without going into any degree of detail on these studies. The evidence is pervasive. It has established that shareholders differ in terms of their tax rate and tax status. Shareholders differ in terms of their time horizon. Some are short-termist and transient, and some are more long-termist. Recent research has also shown that shareholders actually have something like a social or political ideology, and this has been established not only for institutional investors, but also for individual investors. Shareholders differ regarding their governance philosophy. Cross-ownership stakes of shareholders actually constitute another source of potential disagreement. And the ownership type, whether shareholders are family shareholders, founders, CEOs, or maybe a fund that belongs to a union, generate different types of private benefits that also affect the interest of the shareholders. And finally, shareholders differ also in terms of the views about how the world works. They have differences of opinion. Let me pull out two of these studies in order to establish how this heterogeneity not only exists, but is also relevant for price setting and voting behavior, the two aspects that concern us in our paper. Bolton and co-authors have used methodology from political science to line up investors on the spectrum from left to right. Left is -1 on the graph, and that is a group of shareholders who basically have very strongly pro-social views. On the other side of the spectrum, at +1, you have shareholders with a pure focus on financial returns, and then there is a whole spectrum in between. And the way this is done is that the authors establish how current voting behavior can be inferred from patterns of past voting behavior of these funds. And this coherence lets them conclude that there is such a thing as investor ideology, that is a pattern of preferences that is strongly predictive of shareholders' voting behavior. In a different paper with other co-authors, we make use of the fact that after shareholder meetings, if trading is based on asymmetric information, then it affects volume and it affects volatility. However, if trading is based on disagreement on different views of how the world works, it mostly affects volume without having a corresponding impact on volatility. If you look at the graph that shows after the event date, which is 0 here on the graph, how volume and volatility develop, then we see that volatility actually declines very sharply after the shareholder meeting, whereas volume actually does not. And this discrepancy, the gap between volatility and volume, that actually is in some sense a measure of disagreement, and the lack of proportionality between volume and volatility indicates heterogeneity among shareholders that is relevant for the price setting process. So once we have established that shareholders are heterogeneous, how is this heterogeneity going to be resolved? How does this tension work into the decision-making process? There are two standard mechanisms, and both have been investigated by a broad literature. The first one is voting. That's pretty much modeled as we would do in political democracy. But then there's also trading, and because unlike in the political setting where citizens are basically committed to a certain polity, investors can actually choose their ownership stake based on their preferences, beliefs, and the stock price. Both of these mechanisms have been addressed in the literature. What we do in this paper is that we put them together and recognize that they actually create a codependency and a feedback loop. Trading changes the composition of the shareholder base, and at the same time, voting outcomes actually affect trading. And that creates a feedback loop between trading and voting. Let's start with trading decisions. Trading decisions affect the composition of the shareholder base between those who are more supportive and those who are more critical of a certain proposal. The shareholder base then affects thereby the voting outcome. The voting outcome is anticipated by market investors, and the expected voting outcome then feed back into shareholders' valuations with their different values. And these different valuations feed back into the trading decisions, and we start over. This is a feedback loop that is a little tricky to analyze, and that's exactly what we are doing in this paper. Let me give you a helicopter tour of the theoretical framework. The framework is simple. Shareholders first trade, and then they vote on a proposal. The proposal they vote on could be an M&A, a proxy fight, or an ESG issue, something else. Shareholders have heterogeneous attitudes towards this proposal, and we typically use the label conservative for those who are more aligned with the status quo, and activist for those who are more supportive of a change and would endorse the proposal. At the beginning, shareholders trade in a competitive market. After the trading stage has changed the composition of the shareholder base, the shareholders receive some signal, news about the proposal. An example would be a disclosure by management or a recommendation by a proxy advisory firm. Some type of information that is publicly available to all shareholders. And finally, shareholders are going to vote the shares they own after the trading stage. So then the proposal is approved if it gets enough voting support, which typically means that the support is at least 50%. Let me now provide you a little bit of insight into the mechanics of the model. So shareholders receive a signal about the proposal. That is a continuous signal that ranges from bad to good and anything in between. Now we have some shareholders who are more activists, they like the proposal, and that means they require very little evidence to vote in favor of the proposal. So unless the signal is really bad, they actually tend to vote in favor. Other shareholders are conservative. They like the status quo. And they actually require a lot of evidence, and unless there is some really positive information about the proposal, they will not endorse it and will vote against. And we have a continuum of shareholders between very conservative and very activist. Now, there are two ways in which a proposal can collect a lot of support. Either we have a very positive signal, then many votes are going to be in favor, or we simply have a shareholder base with lots of activist shareholders who like the proposal and will vote in favor. Within this framework, now we have a number of implications. The first one is that trading leads to an alignment of interest. We call this investor sorting. Because what is going to happen is that the shareholder base aligns itself with the expected outcome. So if the expected outcome is more activist, the shareholder base will become more activist, and vice versa for a conservative expected outcome. So we see a shift in the shareholder base that then makes the ex-ante expectations self-fulfilling. For example, suppose the proposal is expected to be accepted. Well, the activists are going to like that. They're aligned with the proposal, so they have higher valuations for the shares now. That implies that the activists will now buy from the conservatives who are going to have lower valuations. And if the activists buy from the conservative, that changes the composition of the shareholder base towards a more activist dominance of the shareholder base. And the activist post-trade shareholder base is then obviously going to endorse a proposal with a very high likelihood. And that makes the ex-ante expectation that the proposal is going to be accepted self-fulfilling. Similarly, if the proposal is expected to be rejected, now the conservatives are higher valuations. They buy the shares from the activists, and now the composition of the shareholder base basically moves in the opposite direction to make it more conservative, and now the proposals are expected to be rejected. Both can happen at the same time. The empirical implication of this argument is that we should see a lot of trading volume before shareholder votes. And that's exactly what we see. And the empirical literature actually supports this prediction. Let me talk now about the implication that we pull out from this framework. The empirical, the alignment of interest actually makes poses some empirical challenges. because now firms with the same fundamental characteristics can have different ownership structures and voting outcomes. That is, we have a disconnect between the fundamental characteristics of the firm and the outcomes in terms of ownership and voting. This fundamental indeterminacy, as we call it, is more likely in some cases than in others. So we should more likely see it when there are more transient shareholders and when the index funds have fewer holdings. So when shareholders are willing to trade a lot. And we should see it more on issues that actually generate a lot of heterogeneity. So all polarizing issues like environmental and social proposals that are likely to generate different views among different shareholders are more likely to basically create this kind of non-fundamental indeterminacy. A second implication is that the outcome is not guaranteed to be at all efficient, because there is in some case a coordination or potential coordination failure. Shareholders may coordinate on one outcome, say this is the activist outcome, which is the first case I analyzed on the previous slide, but they might be collectively better off with the other outcome, the conservative outcome, and then the outcome is inefficient. A second implication is that decision makers are not price setters. In our model, like many others, stock prices are set by the marginal investor. So that's the marginal investor here in the middle. Here are the conservatives, here are the activists. So now we have trading, and the marginal investor is just indifferent. Everybody who is more conservative sells, everybody who is more activist buys. So after the trading stage, all the shareholders who are grayed out on the left now here, they're gone. So in the post-trade shareholder base, the marginal investor is now the most extreme shareholder. Now at the voting stage, the decision-making rule is represented by the median voter. The median voter is just in the middle between those who rather vote against and those who rather vote in favor. So that means that now the median voter represents the decision rule, whereas the marginal investor is basically relevant for the price setting in financial markets. And that means that the decision makers, the median voters, are different from the price setters, the marginal investors. Now, if that is the case, if the beliefs of the marginal investor and those of the median voter differ, that implies that stock prices may increase even if shareholder value declines. So that means we could have a situation in which we see the stock price going up, but shareholder welfare is actually going in the opposite direction. And this is the kind of potentially kind of disconcerting implication that we cannot be 100% sure of our standard interpretation of event studies that requires that if stock prices go up, shareholder value must go and shareholder welfare must go up as well. Because this conventional common interpretation that we have of event studies relies on the homogeneous shareholder paradigm. When is this discrepancy between shareholder wealth and the stock market valuation more likely to show up? Again, if investors very strongly disagree, if issues are polarizing, if investors have a common interest, for example, if they have a common conflict with management, this is less likely to be an issue. Secondly, if shareholder votes are close, clearly if half of the shareholders vote one way, half the shareholders vote the other way, there is kind of some source of heterogeneity and disagreement. And finally, if there is a friction to the trading process so that the trading process doesn't allow the turnover of the shareholder base, because trading, as we have seen, leads to a homogenization of the shareholder base. The post-trade shareholder base is more homogeneous than the pre-trade shareholder base initially. And if there is kind of some disruption to that process, that makes it also more likely that the median voter and the marginal investor are going to be different. Does this mean that trade is always a good idea? Unfortunately not. So the news is kind of mixed. The good part, trading gives rise to gains from trade, like in all economics. So in our baseline example with an activist outcome, the conservative shareholders sell to those who are more activist. The more activist shareholder base is going to endorse activist policies. And then the activists buy, pay more for the shares, and the conservative sellers benefit from the higher price. So both are better off. The activists are better off because they're getting kind of the policies of the firm they want. And the conservatives are better off because they can sell at a higher price, or which is going to be better for them than actually hanging on to a firm. Unfortunately, there is a catch. And the flip side of the story is that more trading can make things worse because more liquidity implies that the most extreme shareholders can buy more. So now the shareholders at the end of the spectrum, say, for example, the very activist or the very conservative shareholders, they are now going to basically accumulate very large stakes. That is going to shift the shareholder base to one extreme. The policies become more extreme. And now we can have a situation where the gap between the median voter and the marginal investor may widen, but then the stock price is going to decline if the marginal investor doesn't like what the median voter is going to decide. And similarly, shareholder welfare may decline as well, because the average shareholder may also not like what the median voter is going to decide. The final implication is that there is actually a good case to be a bit cautious about shifting too many decisions to the shareholder meeting. If shareholders are heterogeneous, there is actually a good case for delegating decision-making to a board of directors, with one interesting twist. The delegation to the board of directors increases the welfare of the initial shareholders only if the board is biased in the following sense. It caters to the preferences of the post-trade shareholders. So in our example with the activist outcome, the board is aligned with the activist post-trade shareholder base, which is more activist than the initial shareholder base. Because then the activists pay a higher price with such an activist board in place. And that is what makes this a good outcome. So the conservative sellers benefit from the higher prices that the activist buyers are willing to pay. And the initial shareholders are better off with a bias board than with one that would actually be representative of their views. We have some further extensions, and I'm going to highlight just a couple of them. The first one is index investors. So index investors have become a very dominant player. The big three cast more than a quarter of their votes in the largest firms. So now assume, this is what we do in the model extension, assume a fraction of shareholders only votes but does not trade. Otherwise, these shareholders are completely the same in terms of preferences and attitudes. Then we show that more index ownership makes the median voter less extreme. In some sense, because the index investors do not trade, we see basically smaller shifts in the shareholder base. The second thing is that we see a non-monotonic impact of index ownership on the stock price. So if more index ownership makes the shifts the median voter closer to the marginal investor, then the stock price is going to go up. But beyond a certain point, the increase in index ownership may actually move the median voter further away from the marginal investor, and then the stock price is going to decline. Moreover, we can have a positive impact on the stock prices, but we still have a negative impact on shareholder welfare if basically the impact on the average shareholder and the median voter are different. In the second extension, we look at social preferences more closely. So note that social preferences for like ESG proposals are built into the baseline models, and that's kind of almost a third of proposals these days. In addition, in this extension, we assume that shareholders care about the proposal beyond their ownership of the firm. If that is the case, that actually amplifies the attitude. In some sense, the shareholder base now becomes more polarized. And as we have seen before, polarization is something that actually drives non-fundamental indeterminacy, so that is going to increase. Moreover, this polarization and this kind of everything becoming more extreme also means that the median voter becomes more extreme, and that means that this can have a negative impact on the stock price. To summarize, we identify key economic forces. We identify trading among heterogeneous investors. That means that the shareholder base is endogenous to trading, so voting impacts trading. At the same time, we have the reverse. Expected voting outcomes actually affect trading, so trading also has an impact on voting. This is the feedback loop that I've shown you before. This framework has implications for voting and corporate governance, which we show in our paper, but I would now like to highlight a few kind of further ideas and issues that are also kind of relevant in this framework. The first one is asset pricing. So in a companion paper, we establish that trading can reallocate voting rights towards the blockholder. So we introduce a blockholder and then show that in such a framework where shareholders first trade and then vote, the blockholder now has an incentive to trade in order to accumulate a minority stake, to accumulate a certain amount of control, and that gives rise to the voting premium. So the voting premium arises from shareholders' disagreement and preferences from control and is completely unrelated to any notion of agency issues. The second is that E&S issues and political processes also look differently in this framework because trading among investors with different views on these issues affects firms' policies, and it affects the effectiveness of governance policies and the effectiveness of regulation. And finally, there is actually already an older theoretical literature on bread and butter issues in corporate finance, like IPO underpricing, payout policy, capital structure, and security design, that has not given rise to empirical work. So while empirical work pretty much focuses on the disagreement between investors and management, these papers actually emphasize the disagreement among investors, and that is kind of a gap in the empirical literature which we hope future research is going to address. The bottom line, and on this I would like to close, we put together shareholder heterogeneity with trading and voting. This leads us to strike a cautious note on the movement to shareholder democracy. We argue that trading in the stock market may create shareholder value, but it may also hurt shareholder value. And we kind of want to issue a warning on the trust, maybe the excessive trust we as a profession have put into event studies, which are subject to some serious limitations. This framework has broader implications that range from asset pricing to corporate finance. And we hope that the profession will in the future address this with more work, theoretical work, empirical work, to pull out all the important implications of this paradigm. I thank you very much for your patience and for listening.
Thank you very much, Ernst, for the perfect presentation. Just for the audience, the paper is a theory paper. So if you read the paper, you will find many more of the details underlying the actual model and theory. But Ernst, during his talk, emphasized the empirical relevance and practical implication, which I think is a very good idea for our webinar. So we're going to start the Q&A session. So I see there is already one question in the line. So feel free to add as many as you want. But to kick off the discussion, Shastri is going to ask a few questions directly to the authors, and then we'll move to the rest of the audience. So Shastri, the floor is yours.
Yeah, thank you. And thank you for this informative presentation. Given the implications of your model, let me start off by asking, what do you see as the policy implications of your paper? What actions, if any, should regulators take?
Maybe let me try to answer this. And one point that is maybe not directly answering your question, but still raising from the paper, building on what Ernst said, a lot of the literature when looking at various effective regulations and policy changes adopted by regulators, it tends to look at event studies. And our paper, when striking this caution about the interpretation of event studies. It's not only event studies of voting outcomes, but event studies more broadly. And in particular, judging from the price reaction to a policy change about shareholder welfare may in some cases be quite misleading because price and welfare can move in opposite direction. And that could be especially important for issues where there is strong investor heterogeneity, thinking of, for example, issues that are controversial like environmental, social issues. And in terms of concrete policy implications from the paper, I would say, yes, the main implication is probably this caution about shareholder democracy, that once we think about trading in financial markets, shareholder democracy may not necessarily be the most efficient mechanism to aggregate shareholder preferences. And the flip side of this, we usually think about market depth, market liquidity as being good for shareholders. And this is indeed the case in the model if, say, decisions were made by the board of directors. But under shareholder democracy, when decisions are made by voting, trading, more market depth, liquidity can actually exacerbate the inefficiencies of the voting process.
Maybe a quick, just to add a quick thing. First of all, thank you very much, for hosting this. It's great to be here. One of the things that we do in the paper when we look at delegation, we kind of highlight how important it is for the board to be aware of who are the shareholders. You're kind of catering to your shareholder base, and we show that in that sense there is a benefit for the board to, maybe to cater to the more kind of extreme or shareholders with stronger preferences. So one thing which the paper kind of highlight is that knowing your shareholders is extremely important, and policies that would promote that kind of more transparency of the shareholder base, or at least for the firms to understand, the objectives of the investor, at least the largest investor, that can actually go a long way in improving firm decision making.
Thank you. And let me dig a bit more into your response. You mentioned the divergence between the price and welfare and the shareholder democracy. So expanding a bit on that, should firms seek to maximize shareholder value? And if yes, which value? Is it price, welfare, and which shareholder?
Okay, let me take on this one. No, this is obviously a great question and a very important one. A lot of I think people are thinking about what should be the objective of the firm, and what's the purpose of the firm, and and in many ways our paper take the approach that shareholders might care about things which are not necessarily just the profit of the firm, or even when they think about profits, they might have, different investment horizons, different risk perception. And of course, more recently, people have been talking a lot about, environmental and social objective, which make things more complicated. So we take the approach that voting is clearly a very important mechanism to perhaps aggregate those preferences. And an investor not just voting according to the preferences, maybe they're also trading. That's kind of the core of our model. We don't, like in the paper, we don't take a clear, or we take it as given that, for example, when analyzing the trade-off between, the voting and delegation, that the board will try to maximize a broader notion of shareholder welfare, accounting for their preferences above and beyond, perhaps, just the firm profits. But I do want to highlight that, as much as, the paper is doing a lot, there are several things that we did, leave outside of the paper. For example, we don't account for agency problems. And there is a lot of kind of discussion in the literature of, when firms are trying to maximize something which is beyond just profit, which is relatively easy to understand and measurable, then that can actually amplify some agency problems, perhaps giving some opportunities for firms to make excuses and so on and so forth. So while we take the view that accounting for those kind of broader welfare consideration of shareholders is extremely important, we do acknowledge that there are some limitations to that. And I think there is like a broader questions even at some level. Should we ask firms just to care about profits and let government, society at large, to deal with those broader societal issues? And like in different papers with other co-authors, we actually think about those questions more clearly in terms of, do we want firms to profit maximizing or do something else? And in particular, how government play an active role in this, and potential interactions between financial markets and corporation, the political system. So this is an excellent question that I think our paper takes, a small step in that direction. That's not the only thing we do in the paper, but I would say, probably one of the most important questions we have now as financial economists.
And in your response, you talk about the shareholder welfare. And I wanted to ask a bit more about the shareholder welfare. More specifically, do you see room in your framework to explore different interpretations of welfare? So in the paper, you discuss shareholder welfare, which you define as the average valuation of initial shareholders. And different entities may have alternative definitions of welfare. For example, competition might be one definition. And so I wanted to ask, does a framework allow for alternative definitions? For example, competition as a form of welfare?
This is a great question, and maybe right when you think about competition, we think about thinking of broader set of stakeholders affected by companies' actions, like for example consumers. So one thought is, the paper does, that is definitely a competition, and for example, the literature on common ownership that talks about how certain shareholders may have different incentives from other shareholders with respect to competition between firms. That could be one source of heterogeneity between shareholders that we highlight and study in the paper. It's the differences in objective functions. That said, in the paper, we focus on the utility of the shareholders directly, and in this particular application, that the utility of common owners versus not common owners, and we don't study the implications to the broader society, such as consumers. However, follow-up literature, the paper that Doron mentioned, some of the papers that Ernst mentioned in his follow-up slides, they take this broader perspective. What if we think about a broader welfare, thinking of consumers or of the society at large, and study how trading will affect, in this context, the welfare, will affect the regulations or the effect of those regulations.
Thank you very much for this great discussion. So we have already a bunch of questions in the Q&A. So I'm going to pick a few to start the discussion. Just a few words. So what I liked about one of the things I like about the paper is this. It also speaks to the evolution of both the field of corporate finance as well as your participation in financial markets, and more broadly, the evolution of our society. So if you look at the big picture, so corporate finance started with simple models of asset pricing and simple models of management and shareholders. And the first question people were really asking was, what's the optimal debt structure? How much debt, how much equity, what's the optimal leverage? And of course, then we had the benchmark Modigliani-Miller, a theorem that says, well, it doesn't matter. Of course, it doesn't matter because in the basic model, we assume that the frictions, the tension, the disagreement between debt and equity can be handled properly. So in that case, yes, it doesn't matter that the firm has more or less debt. Once you introduce disagreement or incentives, then we have a theory for why these conflicts are relevant. The next step was to think about agency conflict. Okay, so we move from conflict between debt and equity to conflict between outside investors, be it debt or equity, by the way, and the management. Okay, and that's the literature of the 80s for sure, most of the 90s, where a lot of research, both in theory and empirical, focus on agency conflicts, where exactly as Ernst said, the focus is we have a class of outside investors, and we assume them to be homogeneous, or at least to be dominated by common value. I think that's the right way to interpret all of that, by the way. The common value theme is the dominant one. So if the common value is the dominating factor, then it's safe to assume that shareholders are homogeneous. And then you can focus on the agency conflict, which is essentially asking, are the managers going to act in the interest of the shareholders? And that literature led to a deep insight about incentives, about delegation to a board who's better informed, and all of that. And I think that, of course, it was obviously the right path for research. It also reflected, to some extent, the financial markets and broad societal issues of the 80s and 90s, where the common value was still probably the right framework. So now fast forward to today. So what do we have today? Well, we have essentially two big conflicting trends. One is the rise in index ownership, which means that in a sense, the biggest shareholders tend to be a big, broad, diversified index fund. So to some extent, forcing everybody back to the median. But on the other hand, in society at large, we observe a lot more polarization. Okay? So polarization is another way of saying sorting, which is another way of saying participation is endogenous. These are all the same thing. Right? So now we live in a world in which society is more polarized, and at the same time, the private value components have become relatively more important. So you can think of this evolution as think about the relative importance. So in the data, in the empirical data, that would be like the relative variance of the common value versus the relative variance of the private value. So I think one can argue that because of the challenges we face today, the variance of private value has increased relative to the variance of common values. So suddenly in that world, thinking about dispersed shareholders becomes more important. And I think that this is how the paper fits, in a sense, in the broad evolution of finance in society. And then not surprisingly, what we find is that when you're in a world where the common value is relatively less important and the private value is relatively more important, then simple democratic rules do not work very well. That, by the way, is also exactly what happens in political democracy, which is one of the reasons we have issues with political democracy in many of our countries is precisely because the share of the relative salience and importance of the common value component has decreased compared to private values. And this is also what we see in financial market, and that's exactly where this paper fits in. So I think that's kind of a very nice, overview of finance as a field and finance in society. So then it begs a bunch of questions. Like, what do we do in practice when we have a world in which simple democratic rules may not always give the optimal outcome? Well, one thing we do, of course, in practice is we invent delegation. That is, we put buffer in between the preference of the public and the actions of the decision makers. So that's, in democratic society, of course, that is all intermediary associations that stand in between direct the voter and the government. In the case of firms, it is first the board and then the regulator. So Shastri already asked great questions about what the model has to say about regulation. So I would like to ask about delegation to a board. You mentioned it in the talk briefly, but that also came up in the Q&A. Different countries have different natures of boards. Some have dual-tier boards, some put the So there are different ways to organize and delegate power to the board. So I would like you just to tell us what you think based on this research, what we've learned about, the right trade-off when designing the mandate of the board.
let me see if I can, take a first stab at this. First of all, wonderful overview of and summary of, I think, of some of the key development in financial markets or society. And thanks for placing the paper, this way. I think that's very nice. There is a big discussions about, how boards should be, what should be the composition of the board, and particularly to what extent you want to give stakeholders, which are not just shareholders, some representations, right? Germany is known for that. They have this co-determination and giving some employee representations. And if you think that kind of goes into the shareholders' welfare, caring about employees and board of societal issues, then now from the lens of our model, implement what we call a board that is catering to shareholders with strong preferences. One way to do that, to kind of quote unquote bias the board, is to actually place some stakeholders that perhaps are more dedicated, or directors that are more dedicated with a specific stakeholders objective. That said, I don't think our paper is really analyzing all the various trade-offs that would exist once you have this mix of heterogeneous directors. But I think at least that's one kind of direct implication coming out of our paper.
Then I'm going to pick two quick questions from the Q&A. The first is a nice, clear theory question. What happens if shareholders can trade after the voting stage? And I'm asking because Ernst showed data about that, and I'm sure, guys, you guys have thought about it. So what happens if they trade after the votes?
Happy to answer this. We do consider this as an extension, and one particular application that comes out of it is actually quite consistent with the empirical evidence that shareholders after the vote would trade, for example, out of the firm, would exit the firm if the vote does not align with their preferences. And Ernst's paper with Miriam and Sophia that he mentioned shows evidence in line with this. Another application that comes out is actually the price reaction to the voting outcomes and what we referred to before about this interpretation of event studies to voting outcomes.
Thank you. The next was, actually, I think Ernst just answered it on lines, but still want to ask it live. So in practice, we see that most proposals are rejected. So how does that fit into your model?
Yeah, maybe I can just say what I just posted. So I think it fits the model well, because we should expect that there are some extreme shareholders who do not get the majority support for their votes. So that's an implication of the model. And in some sense, this shows that the shareholder meeting is not just a device to control the board of directors, but it's also basically an institution that resolves conflicts among the shareholders. So there are some shareholders that have some extreme position on certain proposals, probably some private benefits associated with them. And then it's the kind of the job of the shareholder meeting to actually screen the proposals that serve the purpose of the majority from those that don't. And that is what we see. And what we show in this related paper Nadya just talked about is that many of the outvoted shareholders actually later sell.
Yeah. Okay, last question. I think I still think that the interaction with the passive, the rise of passive is very, very interesting. Of course, obviously, we could imagine the passive themselves offering fund with different voting strategies, in which case the sorting will happen at the mutual fund level. Whether we see that or not is a question, and whether it's a good idea or not is another question. But broadly speaking, how do you think the rise of passive investor will affect the issues you're looking at going forward? I think you're muted, Nadya.
I thought Ernst was starting to say yes. So one, Ernst, did you want to say something?
No, I was actually typing to answer a separate question. Sorry.
Yeah, so I think in terms of the passive investing, partly one implication we have, so we talk about the swings in the shareholder base and how outcomes, in some sense, this raises the polarization of companies when shareholders sort into companies based on expected outcomes, and that makes outcomes indeterminate. So here, broad market-based investing can actually lessen and weaken this process, because we have these investors who do not trade. Even they may have very strong views on how shareholder companies should react, but they will not trade on this information. Instead, they will act on this information in their votes.
Perfect. Well, so thank you very much for joining us. Thank you in particular to the Brattle Group, and thank you, Shastri, for joining us today. It was a pleasure to have you. And congratulations again to Nadya, Doron, and Ernst for their well-deserved prize. And I hope we see you guys next year for the next Brattle Prize.
Okay. Thank you, Thomas, for hosting this.
You're welcome.
Thank you very much, and thank you to the Brattle Group for the prize.
Yeah, thanks to the Brattle Group.
Thank you.
Congratulations again to the winner. And as Thomas said, looking forward to it next year.
Okay. Thank you very much.
Have a good day, everyone.
Bye-bye.